Good morning, good afternoon, everybody. My name is Michelle Louie. I am the Executive Director of the Financial Management Association International. I'm very excited to welcome you today to today's research seminar in finance, economics, and banking, a collaboration between FMA and the Finance, Economics, and Banking Research Network, FEB-RN. With that, I'm going to cut my speaking portion off now, hand it over to my friend Cesario Mateus to get us started today. Cesario?
Okay, thank you, Michelle, and a warm welcome to everyone. The FEB-RN is a research collaboration of 25 universities worldwide. Igor Lončarski, professor of finance at the School of Economics and Business, University of Ljubljana, Slovenia, one of the FEB-RN university partners, will moderate our seminar today. So I pass to you, Igor, and you move from there.
Yes, thank you, Cesario. Good afternoon, everyone. Or good morning, wherever you are, or even good evening. We are globally present. It is our pleasure to welcome Karin Thorburn today as our speaker. Before I pass a word on to her, a couple of words about her as an introduction. So she is a research chair professor of finance at NHH Norwegian School of Economics, as well as adjunct full professor of finance at the Wharton School of University of Pennsylvania. After completing her PhD at Stockholm School of Economics, she started her academic career first at the Tuck School of Business at Dartmouth College in US. Her research focuses on M&A, credit, bankruptcy, IPOs, corporate governance, corporate social responsibility, so broad areas of corporate finance topics. She publishes regularly in leading academic journals, including Journal of Finance, Journal of Financial Economics, Management Science, Journal of Financial and Quantitative Analysis, etc. She's also, I think, one of the former academic directors of FMA International, research associate of the Center for Economic Policy Research in London, research affiliate of the ECGI, so European Corporate Governance Institute in Brussels, as well as formerly a council member of the Society for Financial Studies and director of the Executive Committee of the European Finance Association. I'll stop here. I mean, it's a long list, goes on, also in industry, involvement in the industry, etc. But we want to give the floor to our speaker today. So Karin, we look forward to the presentation of very interesting topic, conditional pecking order. By all means, please, the floor is yours. We have up to 45 minutes for the presentation, followed by the 15-minute Q&A, and then we'll wrap up. Again, thank you for being with us today. Looking forward to the presentation. The floor is yours.
Great. Thanks so much for having me. So I'm going to share my slides here, and I'm very excited both to be here and to be able to present this paper. It's a collaboration with two colleagues in Norway, Tore Leite and Chang Wu, and it's very early work for us. So this is really my first seminar presentation. So I'm very excited to hear what you think about it and to hear your comments on what we're doing. Let's see here. So the background for this is really firm's decision to issue debt or equity. I mean, the two dominant theories of what you typically probably think of as capital structure, I'm going to posit more as capital structure adjustments. So when firms decide to adjust their capital structure, you know, traditionally the trade-off theory, it's about tax benefits and bankruptcy costs. And in that theory, firms change their capital structure when it deviates from some optimal point and when the cost of the adjustment is lower than the rebalancing costs. In the other dominant theory or main theory, pecking order, firms make decisions based on their adverse selection costs, where they first prefer internal funds, then debt, and lastly equity. And I dare to say that there is a mounting evidence that's consistent with pecking order, even if there may be parts of both in firms' decisions. Ekbo and Kisser has two review of finance relatively early, where they show that rebalancing costs can't explain leverage adjustments, and there is a negative relationship between profitability and debt issuance, which the pecking order predicts, and not the trade-off theory. Also for firms that already incur rebalancing costs and where it would cost nothing to get it to adjust it in the right direction. So what we're doing here is that we're working off the Myers-Milhoff model, and what Myers-Milhoff do not do is to formally model debt. They hypothesize or conjecture that debt implies less adverse selection cost than equity, and therefore debt is always the preferred security. And unconditionally, it will yield a less negative market reaction than equity. What we do here is we're going to add debt formally into an MM setting. And out of that comes a lot of interesting predictions. The first one is that both debt and equity issues imply some type of rationing. And with rationing, I mean the classical MM result that the highest value firms, they don't issue. They also don't issue debt. And therefore, our paper predicts that debt is going to yield a negative market reaction. And to our understanding, we're the first paper to actually predict a negative market reaction for debt issuance. The second result is that among the issuers, first the highest value issuers, they don't issue, but among the issuers, there is a pooling equilibrium. So the lowest valuation issuers will mimic the highest valuation issuers. And sometimes the preferred security will be equity and other times debt. So our paper actually predicts that firms optimally should issue equity sometimes, which the old pecking order doesn't. And finally, what we find is that conditional on the equilibrium choice of security, the market reaction is less negative for debt than equity. So I'm going to quickly show you how we get to these results, and then I'm going to show you how we test this prediction in a big sample of debt and equity issues, and where we also find support for the model. There is a lot of related literature. I'm not going to go that way right now since I don't have that much time. But briefly, I just want to say that there is no other model that has this prediction of a negative market reaction. And the only way to get this negative market reaction in an information setting is to have asymmetric information about the assets in place, just like MM assumed, and as we're going to assume, but the previous papers, some do, some don't, but not with this mix of securities and rationing as we have in our model. So just briefly, the model setup, we have a firm with assets in place and a positive NPV investment opportunity. The value of the assets in place is A, it's continuously distributed, and the asymmetric information is about the assets in place, just like in Meitz-Machluss. Only the firm knows A, investors know the distribution. And then we have a project, very simple. It requires an investment I and will yield in the next period V over Q with probability Q. So you can see with the risk-free rate of 0, the NPV of the project is V minus I, where for a given V, lower Q implies higher project risk. And of course, higher Q, lower risk. And that's a result that I'm going to come back to, or an assumption, I should say. The project is only symmetrically informed, or the information about the project is symmetric. So investors know the same thing as the firm, so they can assess this Q. And the firm must go to the market to issue debt or equity to fund the project. The equity decision maps Meitz-Machluss very quickly, but just so you understand the intuition of how we get to the results, I'm going to just walk you through the basics. If the firm issues equity, new equity investors will receive a fraction alpha of the firm's total cash flow. And their break-even constraint is obviously the alpha of the firm that they own times the expected value of the assets in place. Given this threshold, we know that the highest valuation firms don't issue, given that the firms issue, plus the project payoff V, and that needs to equal the money that they give the firm. From the that's going to be one of the constraints that we need to take care of, and the other constraint is, of course, that existing shareholders, they want a positive expected payoff. There is no agency in this model. So if they issue equity and invest, they're going to get a payoff U of E, which is then 1 minus alpha, the fraction of the firm that they retain, plus the assets in place and the project, the cash flow. So their net payoff is then the difference between issuing and not issuing. And if they don't issue, they just keep the firm. And this is the expression for their net payoff. Really, the project NPV minus what they have to give up of the firm and the undervaluation or potentially overvaluation of the firm, since investors don't know the true value. I'm going to call it the dilution cost, and I'll show you why it has to do with the fact that it's the highest valuation firms that will make the decision, the security choice decision. So the firm will issue equity if their net payoff is positive. And from this, when we set their net payoff to 0, we're going to be able to derive the threshold here called A bar E, below which firms will issue and above which the highest valuation firms will not issue. And that's the rationing that we know from the Myers-Milous. Now, we're going to do the same with debt. We assume that Q, project risk, is below some threshold Q0, so there will be rationing. And that's the interesting case that we want to examine. Unlike equity, where you give them a fraction of the firm, debt investors receive a fixed payment of D. So then debt investors break even constraint, which we need to consider, it's that the likelihood that they receive D, which they will if the project success, remember Q is the project success probability, plus the likelihood that the project fails times the assets in place, the expected assets in place, because if the project fails, they're gonna get their payoff from the existing assets in place. That needs to equal the money, the investment, the funds that they give the firm. So similar to the equity case, we can compute the expected net payoff to the existing shareholders if they issue debt and invest. And we call this net payoff delta UD, which will be this the benefit from issuing and investing, or issuing debt and investing minus the firm value if they don't. And you can see similarly here they get I can call it a debt dilution cost. That's going to be the cost of issuing undervalued debt. And above it was an alpha here for the equity case. Now it's 1 minus Q. So we can, for debt, also derive the threshold AD. That's determined from setting this equilibrium condition to 0. And this threshold will increase both with project NPV and with Q, which it won't happen with the equity. And similar to the equity case, firms will issue only if the assets are worth less than this threshold, because above that, it's going to be too costly to issue debt. And that's the rationing in this model. So now we come to the equilibrium security choice, and that's where it's getting interesting. And if you look at this figure, we have two situations, and before we derive the thresholds, but let's now just take them as given. In this figure, I'm going to show you what happens when the threshold for equity is greater than the threshold for debt. And here is the net benefit of issuing either debt or equity. And so you can see that if the value of the assets is between AD and AE, the firm is better off issuing equity because this is the equity payoff. If the firm value is below this threshold for D, here the firm is better off issuing debt. And down here, in order to make firms with values down here behave like these guys, we impose some out of equilibrium beliefs, A star D. And with those assumptions, you can show that the highest valuation issuers here, they will issue equity. The lower valuation issuers, they will also issue equity to mimic the higher valuation issuers so that they pool with them. And that's the partial pooling equilibrium. If AD is higher than AE, we're going to get the exact reverse result, that up here they're going to issue debt, and down here they're going to prefer equity but issue debt to pool. So when we mix that, we're going to get our first proposition, which says that if the threshold for equity exceeds the threshold for debt, then all firms with a value below this equity threshold will issue equity and invest, and the higher types will not. The opposite, if the equity threshold is below the debt threshold, so they are switched, then the types below this threshold for debt issuance will issue debt and invest, and the highest types do nothing. What's going to happen in equilibrium is that issuers prefer to issue the security that implies the highest value marginal firm or the highest threshold, and that's because then they're going to have the least dilution cost or the lowest adverse market reaction, the least negative. And the second thing to note is that the relationship between Q and alpha actually, so the project risk determines whether AD or AE will be higher, so which threshold will be higher. And that's going to give us our first corollary that for high Q projects, issuers will choose debt, and for low Q projects or high risk projects, issuers will choose equity. So you can see that the project risk, which is known to everyone, is going to decide the equilibrium security to issue. So it's the issue decision that's going to give us the information that the market reacts to. Here is a different way of just picturing what's going on in the model. And now I'm going to show these thresholds as functions of the project risk. So in the previous graph here, I showed the benefit as a function of the firm value, but here we're going to do the threshold as a function of the project risk. So you can see here, if I map the debt threshold function as a project of risk, it's increasing because it's a function of Q for a given V, while the equity threshold function is actually flat. It doesn't increase with Q, and the firm will always select the highest threshold, the security with the highest threshold. So you can see that if Q takes values here between D and Q naught, QD and Q naught, that is going to be the preferred security because it implies the highest threshold and the highest expected valuation, while for risks with projects with lower risk, projects with lower Q, i.e. higher risk, equity is going to be the dominant or the preferred security, because you can see the line here. And in equilibrium, hence, issuers prefer equity when Q is low, i.e. risk is high, and they're going to prefer debt when Q is high or risk is low. If you compare this to what's going on in Myers-Milous, they implicitly assume that AD, the threshold for debt, is always higher than the threshold for equity, and that's why debt always dominates in their setting. So from this falls a lot of results that's in the paper, and I think I'm going to, these propositions and lemmas, I'm going to show you graphically what they are, and then I'm going to show you the empirical implications of them. Really, the second proposition is related to the market reaction, that the announcement returns are negative for both debt and equity offerings, and it's the fact that it's negative for debt that's new, the equity offering, that's an all-known result. So here we're just consistent with other papers. And as a derivation, lemma 1, the announcement return of an issue is less negative the higher the threshold, but then repositing the announcement return as a function of Q, you can see that for equity, it's going to be unrelated to Q, but to debt is going to be decreasing in Q. Proposition 3 tells you about the choice of security and the market reaction, that the preferred security is that with the least negative announcement return. So that's why sometimes debt is preferred, sometimes equity is preferred. And then proposition 4 is that the announcement return of an equity issue will be more negative than that of a debt issue. And as I said, in our setting, this is something that falls out of the, it's a conditional market reaction that consistent or depending on the equilibrium security choice. It's not unconditional as in Myers-Machluf, the traditional pecking order. So here's a graph that's going to illustrate this more. I just showed you how the threshold varied with project risk. That's this part of the graph. Then this maps directly down here. It's the market reaction. First, as long as Q, the project success probability, is lower than Q naught, there will be an adverse reaction in the debt issuance decision. And you can see that the lower the threshold, the lower is the more negative is the market reaction. And remember, in this area, the firm issues debt. So this will be the market reaction to debt issue. Here, equity will dominate, and now we have the lowest point, and here we will have the expected return for the equity issue. So the market reaction to an equity issue will be more negative than that of a debt issue, because that's going on here. And notice another thing too, that here, had we issued debt, this is the expected market reaction, and that's why the firm chooses equity, because it will have a less negative effect in this region, and that's exactly why the firm chooses to issue equity. And the opposite here, debt has a less negative reaction than equity, and that's why the firm issues equity here. But this gives us a lot of testable implications that we are going to take to the data. And here I list the testable predictions so you know what we're going to do. First, in terms of market reaction, which are the main tests, we're going to show you that, or what we want to show you is that the market reaction to the security issue is negative for both debt and equity, our proposition 2. It's less negative for debt than for equity, that's proposition 4. It's decreasing in project risk for debt, but not for equity, and that's our lemma 2. And then finally, and perhaps most interesting, is that it's going to be less negative for the issued security than the non-issued. I'm going to call it the counterfactual security, because it's the security that the firm chooses not to issue. And I'll explain in a little while how we try to estimate that. And that's what falls out of propositions 3. And then finally, more maybe plain vanilla is just a choice of security. In our models, firms want to issue equity when project risk is high and debt when it's low. And that follows from corollary 1. And I'm just going to show you that this actually works in the data too. Now, we're not the first ones to show that. This is just consistent with other models and with the literature at large, but it's also there in our data. Okay, moving on to the empirics, sample selection. So we're going to select, or we have selected, public debt and equity offerings between 94 and 22. It's limited to US firms listed on NYSE, Amex, and NASDAQ, and it's from the FTSE Global New Issues database. We do lots of eliminations. We exclude utilities, financial firms, convertible securities, withdrawn offerings, rights offerings, and shelf registrations. So we want the plain vanilla offerings. And then we match with CRISP and CompuStat and IBES. We require complete information on all the explanatory variables, and this gives us a sample of 6,100 issues. I see here about 2,500 equity issues, about 3,500 debt issues, and they're all sold by 3,000 unique firms. The average firm issued has 3 issues, as does the median firm, and the max of security issuance is 16 of one firm. Half of the firms in the sample issued 2 or more securities. About a third issued both equity and debt, and about a quarter only issue only equity, and 39% only debt. So that's the sample. A few more sample descriptives. Here is just the sample distribution over time, from 94 to 22, and you can see the blue bars, that's the number of debt issues, and the yellow bars are the number of equity issues. So there was a surge of equity issues in the mid-90s, and then I would say in the most recent time periods, much more debt issuance in between. I've also plotted, or we've also plotted, the annual average CAR So the 3-day announcement returns for the issuer around the security issue announcement. And you can see that in general, the debt issues have higher or less negative, because this is 0, less negative announcement returns than the equity issues, which is the yellow line here. And if anything, which we show in the paper, is actually that CAR was not so negative early on in the sample period, but it's become significantly negative in later years. And I'll show you when we get to the tables. Here is a few of the firm characteristics. In the paper we report more, but as you know, it's impossible when tables become too small on the screen. So I selected a few interesting firm characteristics. Here are the equity issuers, and then column 3 or 4, the debt issuers, and the significance of the difference. Their firm characteristics are in general very different, and what you can see is that the equity issuers, they are relatively small. They're high market book, so it's growth firms. They invest a lot in R&D. They're not so profitable. They have lots of intangible assets, high cash holdings, but that's probably because they're such high growth firms, low leverage, and they're young compared to the debt issuers, and they're often in the high-tech industries. So just by looking at the univariate, it's very consistent with the model that it's the high-risk projects and high-risk firms that do equity financing. We also have some market characteristics, just in the univariate for the equity and the debt issuers in the sample. And I just want to point out, I mean, also there are lots of differences, and this is probably not new to most of you, that the equity issuers, they tend to be firms with more volatile stock prices and high dispersion analyst EPS forecasts. Of course, that's related to their high riskiness, while they also tend to issue after the stock market has been doing well. We call that stock price run-ups, and in strong markets, so where credit spreads are low. Anyway, that's the sample description. Now, let me move ahead to the tests. So if you remember, proposition 2 and 4 said that we should see negative announcement returns both for debt and equity issues, and equity should have significantly more negative announcement returns. So in this paper, we're just reporting the issuer CAR, or the announcement CAR for the issuer, for equity issues in these 2 columns, mean median, for debt issues in these 2 columns, and then the difference in the mean and the median. And we estimate CAR using several different models. We use the market model, different windows. We've done a 7-day window too, Fama-French 3-factor, the Carhart 4-factor model. And then we also slice the sample by eliminating, for example, issues that didn't have investment purposes, since the model is about funding investments, or issues done during the great financial crisis, or really small issues. So these are subsamples where we eliminate certain groups. And really what you can see is that the results are incredibly robust. The equity issues always have negative announcement returns, on average around 2%, median around 3%. Debt issues have less negative returns, but they're still significantly different from 0, -0.8 on average, -0.6 median. And importantly, the equity issuers have significantly more negative announcement returns than debt issues. So this confirms the first prediction of the model. And again, because the negative reaction for debt issues is new to our model, it's also interesting that we actually find this in the data. Then to examine lemma 2, which said that the announcement return declines with project risk for debt issues, but not for equity issues. That's our lemma 2. We use the stock price volatility as a proxy for project risk. Now you can say, well, stock price volatility that reflects the current assets, but recall that the stock price is looking at the future. So in the stock price, investors anticipate all the future investment projects. So I think it's fair to use the volatility also as a project for the forward-looking project risk. And when we sort the issuers in stock price volatility quartiles, the lowest quartiles and the highest quartile, you can see that the announcement return for the equity issues, it doesn't vary significantly in any consistent pattern across the volatility buckets, just like our theory predicts that it doesn't influence the threshold for equity, but it does for debt. And here you can see a monotonic decline as volatility increases. The reaction to the debt issue is more and more negative, and the difference between the lowest and the highest volatility buckets is significant. So I would say this is consistent with the theory. Again, of course, we can't reject anything by showing this. We're just going to show you data that fits with the predictions of the model. Then I'm going to look at the issuer announcement car in the cross section. And really, I mean, we don't have that many predictions for it. But of course, one is that debt should be less negative, the announcement reaction which comes out in the cross section too. When we add a dummy for volatility, I'm going to switch this to high volatility, but then you can see that that the debt issues are more significant to volatility than the equity issues. And when we split the sample, so this is equity, this is CAR in equity announcement, and this is CAR in the debt announcements, then you can see that volatility affects CAR in debt, just like the model predicts, but not in equity. And there are more variables here. I just picked some that I wanted to show you. Okay, but then we have the issue that you might be thinking of already, that there can be a self-selection bias in these OLS regressions. We know that issuers, they have an equilibrium choice of security, and of course, if the same variables affect the equilibrium choice, security choice, and the announcement return, the OLS regression coefficient estimates may be biased. So to correct for this potential selection bias, we are going to estimate an endogenous switching regression model using joint maximum likelihood. And the regression, or the endogenous switching regression model, really contains three equations. The first equation is the selection equation, the one that predicts the choice of equity versus debt, and that's a probit regression. And here we're going to have a dummy on the left-hand side, 1 if it's an equity issue, 0 if it's a debt issue, and we're going to run a regression where it's a function of basically the firm and market variables that we showed you initially and that we include in the other regressions. And I'm going to come back to this. We also add an instrument that we argue is affecting the choice of equity and debt, but not the outcome. So let me come back to that change in market liquidity. Then the model also contains two outcome regressions, where OLS is on the left-hand side, where the CAR, the announcement return, is on the left-hand side. We're using here the 3-day market model returns. It's not sensitive to whichever estimation we use for the announcement return. We're going to have one regression that explains CAR in debt issues and one in equity issues. And as I presume many of you are familiar with, in this second stage, or it's not the second stage, but in the outcome regressions, you include the inverse Mills ratio from the first stage regression, and this is going to help you control or correct for the self-selection bias. So this instrument, the market liquidity, let me tell you a little bit about that. So we're inspired by Hanseler, Stultz, and van Dijk where they develop and use the change in annual aggregate stock market liquidity as an instrument for the equity issuance decision, or to predict equity issuance. And really what this instrument does is that it aggregates this is the daily Amihud liquidity measure for all stock. It aggregates it to an annual measure, and then it aggregates it across all stocks. So you really have a liquidity measure for the entire market that's aggregated from the individual daily Amihud liquidity measure up to the market level. And then you adjust it for the total or aggregate market capitalization and how it's changed since the beginning of the sample, in our sample 1994. And then we do the change from last year to next year. So that's our instrument, the change in the aggregate market liquidity. And why is this relevant? Well, you can think about it yourself. If it's a highly liquid market, there are lower discounts when you issue securities. So it's going to affect the likelihood that the firm wants to issue equity, because that's where you get the biggest discount. But when it comes to the CAR, the second two regressions, this liquidity is already going to be priced, so there's no reason to think it will affect the market reaction. That's the exclusion restriction. And then finally, it needs to be exogenous to the issue decision, which it certainly is here because it's an aggregate market-wide measure. So that's the instrument. Now to the endogenous switching regression model. Again, I'm only going to show you select coefficient estimates. And in the paper, you'll see the coefficients for all the variables that are suppressed here. But the ones that I think are interesting to point out, and here we have the selection regression, the two outcome regressions where it's the announcement returns for equity issues and debt issues. And what you'll see here is that the instrument, the change in market liquidity, positively affect the equity, the decision to issue equity. So it just validates the instrument. And then in the two second stages, you can see that this thing came up, but that the inverse Mills ratio is insignificant for the equity regression, but not for the debt regression. So if anything, these are the better, less potentially biased coefficients to use. But importantly, again, volatility comes out significant in the debt regression, but not in the equity regression. What can we see? Well, in general, firms with more risky projects tend to issue equity, because that's corollary 1, and that CAR decreases with volatility in debt, but not equity issues. That's lemma 2. And the inverse Mills ratio's significance, at least at the 5% level, suggests that we need to do this to ensure that we adjust for the self-selection bias. And what we're going to do now is we're going to take these two regressions, and for the equity issuers, we're going to predict the CAR had they issued debt. So we're going to take all the characteristics for a given equity issuer and estimate its predicted, I'm going to call it the counterfactual CAR had it issued debt, which it didn't. It's for the non-issued security. And we're going to do the opposite as well. We're going to take the current characteristics for a debt issuer, plug it into the equity regression, and predict the CAR had this debt issuer issued equity instead. And we're going to call that the counterfactual for the debt issuer. And as I mentioned before, proposition 3 suggests that for debt issuer, the predicted CAR from an equity issuer should be lower. That's really why they choose equity. And for an equity issuer, the predicted CAR from a debt issuer should be lower, and that's why they choose equity. So here are the results. Ta-da! We call it the actual, which is the return that they received from the chosen security, versus this estimated counterfactual, which is the predicted return that they would have received had they issued the other non-issued security. And here are for the equity issuers, we showed the means, and here for the debt issuers. But let me do it one by one and just show you the setup of the table first. As before, when I showed you the announcement returns, now we have a panel A where we estimate announcement returns in several different ways, the simple market model, the Fama-French 3-factor and Carhart 4-factor models, and then for different subsamples where we limit the sample to investment purposes only, eliminate issues during the great financial crisis, and then here it should be no issues under 10 million. We updated that. And okay, so what are the results? Well, for the equity issuers, they had on average an announcement return of minus 2.24% with a market model 3-day window. Had they issued debt instead, the counterfactual, you see the predicted return is a negative minus 3.8%. So they actually had a less negative return by 1.5% by choosing equity rather than debt. And you can do the same exercise for the debt issuers. The debt issuers on average had minus 0.8% announcement return. Had they issued equity instead, so I plug their characteristics into the equity outcome model, they could have expected a negative 2% announcement return. So their announcement return was actually 1.1% less negative by issuing debt than equity. And again, here by issuing equity rather than debt, they also had a less negative return. And you know, that's the result that falls out of our conditional return depending on the equilibrium security choice. Just supporting our prediction that issuers choose the security with the least negative market reaction. That's the end of the test. I just have 2 summary slides, and I think I'm doing well on time. So with the theory model, what we do is we formally introduce debt into a Myers-Milov setting of asymmetric information about assets in place. So we showed that as in Myers-Milov, there is a separating equilibrium where the highest value firms do not issue. But in our model, this holds both for debt and equity. So there will be a negative market reaction to both debt and equity issues. And then we show that the issuing firms, they will pool in this partial pooling equilibrium, where the lower value firms mimic the higher value issuers. So it's the higher value issuers' preference that will determine the choice of security. And this choice of security will depend on the risk of the project, where issuers prefer equity for high-risk projects and debt for low-risk projects. And in our model, conditional on the equilibrium security, we're going to, it shows that the threshold is lower for equity issuers than for debt issuers, and that's why debt issuers' market reaction is less negative than that for equity. And finally, issuers choose the security with the least negative market reaction. We take it to the data. We have a big sample of 6,100 public debt and equity issues, and there we show what the model predicts, that both equity and debt issues have negative announcement returns, that the market reaction to debt issues is less negative than to equity issues, that the equity issuers tend to be the young, small, high-growth issuers that probably have risky projects, as the model predicts, and that the actual announcement returns, the one we observe, they're actually less negative than the ones that we predict that they would have received had they issued the other security that they actually choose not to issue. So overall, the empirical evidence aligns with the model's predictions. I'm at way's end. I'm looking forward to your comments. So Igor, should I stop sharing?
Yeah, or maybe you can leave it if we have some questions about tables or
Okay.
figures. I have one regarding the figures, so maybe easier if we then go back. So thank you, Karin, for this very interesting presentation. I already have some questions lined up in the queue, but maybe I take a privilege and kick off with my own question, which is very, at the top. So what you have here basically fits within this literature on capital structure, right? And in capital structure, as you started off, we have different competing theories, obviously pecking order, trade-off theory, we have market timing, then there's this agreement-disagreement kind of explanation by Dietmar and Thakur from 2007. But what is sort of at the top of this is the basic question whether companies pursue optimal capital structure or not. So how would you see your conditional pecking order with that respect?
So I think it doesn't say anything about the optimality. It says something about the security that you choose to issue at the margin. And, you know, I think that's really true about Mars-Myluf too, and the traditional pecking order. It doesn't tell you really what the exact mix should be, but it tells you which, like when the firm needs funding, whether it's for liquidity reasons or for investments, what security it prefers to issue. So it's more, actually, so I think it's more like about the capital structure adjustment. And we've been discussing maybe conditional pecking order makes you think that it's more about this capital structure decision, but it's really about the issuance decision.
Right, because often we tend to see issuance tied to the capital structure decision in one setup when you talk about, let's say, optimal. And then with the market timing, it's simply related to the opportunity, and you control for stock price run up, agreement, etc. So you have all these there. But what I said to leave the presentation on, there is this figure when you have cumulative abnormal returns over time, both for equity and debt.
Yeah.
So if the pattern that you can observe is that some of the time they sort of co-move, but there are periods where basically they move in the opposite direction. So around 2008, for example, 2015, 16, and then you have this period of 20 to 21. Have you perhaps thought about why this happens?
You know, we talked a little bit about it, but I don't think we have any good explanation at this point, and at least not in the framework of the theory, but not otherwise either. I think in 08, 09, one of the issues is that there were so few equity issues. I think there were only 7 in 08, and of course, only 7. If you only have 7 equity issues, you can get huge variations depending on their situation. Maybe it's more difficult to understand them here. And it's interesting, I think, that it was actually positive. But
yes,
in all honesty, no, maybe we should think more about that. What could explain the time series? We haven't done that because in the cross section, you know, you give each firm equal weight. Here we give a firm very little weight in a year where there is a lot of issuance. Probably the cross-section is a better way to actually do the analysis than to think about it year by year. Because in the cross-section, we also either control for time-fixed effects or for all the different market variables, the conditions, the credit spread, the NBR recession dummy, the stock market run-up, etc.
Okay, so I'll thank you, Karin. I'll move on to the question. So David is asking whether you repeat these tests also for the companies that basically issue both equity and debt, because it seems like, according to the firm characteristics, that there is obviously a difference between those that issue debt and those that issue equity, but there are some firms that actually probably issue both, not necessarily the same time, but at different points in time.
Yes, and that's a good question. Because it's true here in our regressions, it's an issue, it's an observation. So we cluster standard errors by firm because correctly, I mean, there's even one firm that issued many times. But in one of the regressions, actually here, column 2, we do include the issuer fixed effects. So here we do control for the issuer's time invariant characteristics. And here you can see that debt issues have less negative returns also when we control for the issuer fixed effects.
Okay, thank you. Maybe another question that I had sort of. So here, obviously, you have debt as a public debt, right? So
yes.
How would other types of debt, which are not captured by the SDC, affect this? I mean, intuitively, would this be the same or result, or do you think that could sort of play out differently?
It's a good question. You know, I think first of all, we can't include, for example, bank debt because we typically never have any issuance dates. There are no announcement dates. That's why we need to rely on debt issues. But then I think one would have to develop more thought around what's the information asymmetry with the bank. Can the bank do the due diligence so that there is less information asymmetry? So when they make a debt or issue debt, will there be rationing or not? I think one would have to think more around that. And one thing that we did see in the cross section here, now this is with the volatility spreads, but we have looked a little bit around the ratings, and for debt, if I recall correctly, okay, now I think I'm messing it up. But one would have to think more about what kind of information the bank has. Then, of course, a related question is, when I issue debt or equity publicly, I have underwriters, and don't these underwriters do their due diligence? You know, they probably do, but I would say it's likely that the adverse reaction that we observe here is what remains after their due diligence as well. That's how I would think of it.
Okay, because essentially it's a signaling model. So, you know, the question is, when does certain information come to market, even if it's private debt placement, and whether it has any impact. But it's difficult to identify exact arrival of such information to do the event study.
Exactly, and that's why, for example, with shelf issues, shelf registrations, you know, you never really know when they get information, when it's the subsequent issues, and therefore we have eliminated them from the regressions from the sample.
There is another question from attendees audience. Maltieri is asking, if you have a group of firms, so you have a parent firm and then you have subsidiaries, how does this basically intuitively affect your predictions? So when the subsidiaries must choose between equity and debt across parent and multiple entities, kind of like internal capital market, I would say. Would this apply to them as well? I mean, because it's a signaling model, so I'm also not sure how this would intuitively play out.
No, but it's a bit. So then I would say, so then it depends on how the subsidiary is funded. If it's funded by the parent, then it's in the end the parent's decision. Maybe you would say if it's a big, if it's a diverse or diversified firm, maybe the assets in place don't really tell you which division it is where you're going to invest. So maybe the signal then is much more noisy than with a startup firm or a pure play where the assets in place more reflect the project risk. So I think that's maybe the thing that comes to mind, because otherwise, whether it's a group or not, I don't see that it would make much difference in the signaling, except for that it creates noisiness looking at the assets in place where you don't, it tells you less about where they're going to invest, I think. So the Q signal would be noisier.
Okay, thank you. Another question from the audience by Hari Kumar is, he's wondering about the intuition as to why equity cumulative annual returns are not sensitive to Q. Okay, now let's see if I can manage to explain this. It really comes from the derivation here of the threshold. If I just start with the debt, you know, when we said the decision to issue debt has to do with the difference, the payoff from issuing versus the payoff from not issuing and investing. And this is the equation. So you can see that for the debt issuers, Q plays in. For the equity issuers, the same equation. So the net benefit from issuing equity boils down to the NPV minus, here we only have the alpha. And so Q is not a part actually of this function, and that's why the threshold which we obtain by setting this delta, the net payoff, to 0, doesn't contain Q more than through, like, indirectly in the NPV. And when we do this analysis, we hold V constant. So it depends on Q for a given V. So that's just mathematically how it comes out. Now he asked about the intuition.
Do I have a good intuition for that, Crystal? It's a good question. I think about that more actually, and maybe I don't know if my co-author Tore can write in the chat and tell me he's the one with the best intuition, I think, around the model, but I actually have to admit I don't really see what the intuition is, except I see it mathematically, but white you should be in there.
Okay, thank you. So I have a couple other questions which are sort of related. So your model is about assets in place, right?
Yes.
Okay, so is it sort of more reasonable to assume this information asymmetry being about assets in place rather than new projects for which you actually raise financing? Let's say, I don't know, especially if it's about tech firms, R&D, looking at the assets in place, for example, how would tangibility of these assets in place, like collateral, affect this? So this sort of disparity between the two aspects.
Yeah, very good question. There's been a lot of discussion around this in several papers, whether one should really be more concerned about the information asymmetry in the assets in place or in the project. I think theoretically, if the asymmetry is in the project, the firm will only issue when the NPV is bigger than the information asymmetry in the project. And therefore, it will never, there is no rationing. It will only be the positive NPV projects that are funded, and there will be no negative announcement return to anything. So actually, to get a negative, theoretically, to get this negative market reaction, it needs to be about the assets in place. Now you could say, well, why don't we add information asymmetry about the project? I think in our setting, it just adds a lot of complexity without adding additional insights, because the information asymmetry has to be about the assets in place. Then if you think about it more empirically, why is it good to look at assets in place to think of project risk? Well, I mean, I'd love to have a good measure for project risk in itself if there was one, but it's very hard to find empirically. And then I think thinking about at least stock price volatility, we all know that stock prices are forward-looking and they are extremely sensitive to the anticipation about the future and to future cash flows and future risk. So I think the fact that we choose to say that at least with stock price volatility, it tells you something about project risk. And then, you know, the other characteristics, it just gives you a general view of the firm, where I think it's fair to say that the high growth R&D intensive young firms, they're the ones typically with the higher project risk. But you know, of course, it's not any exact measure. It's just some type of proxy to try to capture this unknown project risk empirically.
Okay, thank you. And final question, because we'll be running out of time. So the question is a bit related to what I asked before. We're looking at this chart of cumulative abnormal returns. So to what extent does monetary policy, especially we just came out a couple of years ago from this zero lower bound, extremely low interest rate environment. So to what extent would monetary policy affect firms' preferences for debt or equity, conditional on the project risk? So taking into account, when companies make decision, the financing conditions.
Interesting. I think, you know, I didn't give this any thought before, but when I think at the top of my mind, I'd actually like to go to the selection equation here. You know, monetary policy, I think, could affect market liquidity, actually. If you pump a lot of money into the economy, you could get much more liquidity. And to the extent that market liquidity actually influences equity issuance, that's the way I think it would play into our model here through the selection, and then indirectly, you know, into the OLS. Are there other ways? None that I can think of directly, more than, you know, we know from the existing literature that there is this correlation between like good market conditions, strong markets, business cycle, how the business cycle is doing, and equity issuance. So of course, to the extent that monetary policy is related to the business cycle, then we would see the correlation there.
Okay. Actually, if there is a figure you have looking at the split between equity and debt issuance, and you see that they are not evenly sort of distributed over the period, and probably also aligns a bit with the conditions of the firms, whether they really need to make use of that or equity and the financing conditions, etc. Okay. Thank you, Karin, for the presentation and answers. Thank to all the attendees asking questions. And I'll wrap it up here. Thank you.
Okay,
Thank
thank you,
you.
everybody. Have a good day.